What's up, everyone? Welcome to the daily macro update for Wednesday, August 20th. Not too much in terms of macro data, but we did get the Fed meeting minutes from the previous meeting. Why look at these even a month after the meeting? Well, it does provide a little bit more context into what was said. And sometimes there is some added commentary in there. And so we'll go ahead and go into that. But first, the market is having some anticipation into the Jackson Hole speech. This is the last Jackson Hole speech that Jerome Powell will be having during his term here that is up next May. And so, yeah, I mean, we're at pretty much a crossroads in terms of Fed data, only because we're in a stagflationary environment, which is really like a central bank's worst nightmare, right? So just like the word says, it's stagnant growth with, higher than expected inflation or rising inflation. And so it's helpful to know exactly, what the Fed's stance is with inflation because, if we go back to the other two times that we had this Jackson Hole speech here, taking a look at the charts, you can see that in 2023, you did have a little bit of a jump right after it, but then what ensued was, about a, 9% correction over how many days was that? That was essentially, a 51-day decline from there, right? So that's nearly 2 months of continued decline before it, obviously went higher. And then what happened before last year was you did see a little bit of a sell-off, right? You had about a 4 to 4.5% correction over about a 10-day period before ultimately ended up going higher from there. Now, what's interesting is that both of those two setups were completely different. The two charts that I have above here are the 2-year U.S. government bond yield versus the 10-year U.S. government bond yield. And so what's interesting about this is that, leading up into the 2023 Jackson Hole speech, you had both the 2-year as well as the 10-year rising on inflation fears, right? So if you guys remember back then, it was all about inflation. We were just coming off of 2022, where you still had some, pesky inflation. It was coming down, but the Fed ended up ultimately not cutting any rates at the Jackson Hole speech. If you remember, that was the one where a lot of people were critical of Jerome Powell because he sounded very hawkish, and then ultimately what ensued was nearly 2 months of a continued drawdown before this thing just ripped higher. And so, what happened last year was you had a continued deceleration in bond yields in anticipation of a rate cut, and then once that happened, you had a little bit of a wiggle with the market, but ultimately it ended up going higher pretty quickly. It did not have a continued downtrend like we had in 2023. But then you did have bond yields continue accelerating higher from there. And so, taking a look at what we're seeing right now, you have bond yields pretty much remaining flat. I mean, you do have the 2-year yield declining faster than the 10-year yield, right? As you can see right here. And so this ultimately has caused the yield curve to remain flat on a trending basis, right? So pretty much since April 15th of this year, you've had a flattening of the curve, but, over the past, 3 months, you've actually had the 2-year yield, so the short end of the curve, fall faster than the long end of the curve, which has caused a little bit of a steepening effect, which, that is stimulative for risk assets, right? That's signaling that the Fed is going to have more easier monetary policy, right? But what's interesting is that, ever since, if we zoom in here, the yield curve has done what's called a bull flattening, which is typically when the 10-year yield falls faster than the 2-year yield because of a weakening economy. Now, that doesn't mean that, the S&P 500 is going to fall based on that. It just really depends on the sentiment towards what the Fed is doing, and so it's just a unique period right now because you have this stagflationary environment, which we really haven't seen for quite some time, and so the market still doesn't know too much how to make of it. But still remains in bullish trend, right? So you see that in the background, we have the green light on still with the bookshelf. Today provided a great buying opportunity again, similar to what we saw back in early August. And so, yeah, we'll see what happens. I mean, one thing that I was noticing was that, you do still have a very low volatility index, right? So the VIX, this is at really low levels. I did have a little bit of a spike here today up into the 17s, but quickly was, going lower there. And so it remains pretty low. And so I think what the market is ultimately looking for is for Jerome Powell to signal cuts as well as further cuts. That will cause the markets to enjoy that. Now, of course, it depends in the context of what cuts are, because you could cut rates because of the economy going into recession, or you could cut rates because inflation is starting to come down and we're starting to enter a recovery mode. Obviously, the market would prefer the latter than the former, but yeah, I mean, it's just a tricky environment currently. But we can go ahead and go over the Fed meeting minutes here that came out today. Now, you can go ahead and read these for yourself. It is a decent read, but we'll just go ahead and go over some of my notes here. Now, obviously, they decided to hold rates during the last meeting, and the entire focus was on inflation. It was considered a slightly hawkish meeting, if you guys remember, but essentially the entire inflation blame was being blamed on the Trump tariffs. And so, as you take a look at the different CPI numbers, you're starting to see goods inflation come back a little bit, but it's really just normalizing to what it was. But the real deflationary or disinflationary aspect of the CPI, from what we're seeing, is in services, which make up a large majority of the GDP in the United States. And so, if inflation is slowing with services, that can also be contributed to slowing demand, which is what we've been seeing really on the services side. And if it gets too slow, right, that's when the Fed would want to come in to make sure that that doesn't get worse. But the only problem is that if they end up cutting rates right now with the markets near all-time highs, Bitcoin near all-time highs, housing prices still at all-time highs, they risk that inflation returning. And so that is really what the worry was. There were some people on the FOMC who actually dissented, meaning that they were going against what was being decided on. Typically, it's pretty unanimous, but sometimes you'll get those dissents. I think the last time was like in the early 2000s, so it was pretty interesting there. A little bit of shakiness happening over there at the FOMC. But despite all of this, the Fed was still guiding that they still see anywhere between 1 to 2 rate cuts in the second half of 2025. So the whole thing was, gaining full clarity on tariffs and its effects on inflation. That's part of the reason why during the CPI print last week, the reason why the markets rallied was because it saw that there wasn't too much inflation due to tariffs, but then it quickly reversed. As we saw in the PPI number, it was pretty obvious that tariffs were starting to grip producer prices, right? And so it takes a little bit of a lag for those accelerating producer prices to then get pushed onto the consumer side of things. And so that's really what spooked the market. So yeah, the majority of the FOMC, the Federal Open Market Committee, saw upside with inflation due to the tariffs, and that was pretty much the main risk. The financial conditions remain, pretty adhering to favorable liquidity environments, right? So equities are up, credit spreads are tight. The dollar has been bearish and it has softened a lot, which typically signals that the Fed is going to cut rates. And then you also had pretty decent, earnings season as well. And so, with that backdrop, you could still see the market inch higher because really, as we know, there's a very highly large concentration into those Mag 7 stocks. And so, if you continue to see that go higher, you'll keep seeing the market go higher. They did talk about briefly of how they continue to try and drain the RRP in order to, fund the government. Those reserves will likely continue to decline and get near zero. Now, what we can do is we can go over and, take a look at that chart right here. If you guys wanted to put this on your chart here, this is the RRP ONTSYD. And as you can see, pretty much since the beginning of August, this thing has gone from 134 billion down to 34 billion or 35 billion. So nearly $100 billion has been taken from the RRP and in turn gone directly into the Treasury General Account, which you can think of that as the Fed's or the government's checking account that's held at the Fed. They're having to raise cash in order to be prepared for if there's any type of liquidity crunch where the government will have to fund, spending as that liquidity crunch happens. And so they're definitely trying to just squeeze essentially everything out of the RRP and put it directly in the government's hands. And so, with the crazy amount of issuance that's going on with bonds, as well as there being a little bit of a lacking demand, nothing too crazy, but you're starting to see a little bit of lacking demand there. The whole thing is just with the government right now is they're trying to raise as much cash as possible. That's why they're pushing. That's why they pushed the Genius Act with the stablecoin, with the stablecoin policy, right? So this is to also raise treasury demand, right? So all the people who are very cryptocurrency focused, who are celebrating about the stablecoin policy, it's not because they're trying to be pro crypto. It's because they're trying to raise cash because liquidity, they see a liquidity event happening or potentially happening soon, right? Just like how, like, if you and I had some type of large credit card bill and the due date was coming up, what would you do? You would probably start, selling stuff or, trying to gather as many dollars as you can in order to make sure that you have enough liquidity as your debt increases, right? And so, as this suppresses volatility in the short term, ultimately, if this gets out of hand, this could cause volatility to spike up because, essentially the duct tape and the Band-Aids that the government has been putting on the financial system, they could erupt, right? Now, I'm not saying if that'll happen anytime soon. I'm not saying the magnitude of what that would look like if it does happen. There's no really way to tell, when that happens. But obviously, when you look at moves like this, where the Fed is doing insane amount of juggling and making sure that the government is being funded, and then you have the government trying to raise cash and issue debt at the short end. I mean, they wouldn't be doing all of these things if they didn't see issues underlying, right? And again, the whole problem is like if they're trying to do all these things because they're absolutely trying to do everything that they can to not go into full-blown QE mode, unless things get really bad, right? Because the whole name of the game right now is trying to buy time in order to see if we achieve a soft landing. Because if that happens, you're going to have some crazy moves happen in the market. Obviously, the market has been grinding higher for the past 3 years because it has a high confidence that that will actually be achieved. And so any type of moves that happen from here that end up hinting more towards the success of the government as well as the Fed achieving that type of soft landing, which is definitely possible. Has it been achieved a lot of times in the past? No, it's not the most likely path. But the market definitely seems to have confidence that they'll be able to pull this off. So until then, I'm not just going to be waiting on the sidelines, not trying to capture a lot of the upside that could still continue to happen well into 2026 as all these things start to still build up. That doesn't mean that you should just be waiting on the sidelines either. And so, if you want to have updates as well as learn all this macro and how to actually use it on a day-to-day basis within your own portfolios, that's what we do at Macro Optics. We help show people our strategy in the context of strategic positioning and looking at the markets through a macro lens, hence the name Macro Optics, a little bit of a play on words there. Then I would recommend going to our website, macro-optics.com, and taking a look at some of our free stuff, as well as we have some resources there that you can at least get started. But yeah, so the issue right now, though, is the Fed really needs to make a decision, and it's a lose-lose situation because if they end up guiding more towards hawkishness, you could have the market start to sell off. And then if they guide to more so dovishness, you could have a relief rally in the markets, but that might be a short-term thing. Short-term meaning maybe now until the end of the year. But in the long term, that's obviously going to have problems because now the cat's out of the bag with the government 100% being in a fiscally dominated type of environment, and when that happens, I mean, long term, it's just really not good. I mean, if that's what is decided, I mean, long term is just going to be even more pain, coming down the pike. So yeah. That's pretty much what I was looking at with this FOMC press conference or with the Fed meeting minutes. But yeah, I mean, a lot of the Fed officials, some of them were worried about the weakening labor market. Some were saying we needed to already have cut by now, which there definitely is an argument for that. But when taking a look at the Fed fund futures right now, there's still an 83% chance that they're going to cut in during the September FOMC. We'll see how this changes and swings by the time Friday comes around. And now the probabilities of a continued pause has risen up to 17%. This time last week it was at 0. So obviously something has shifted into more of a concern with inflation, especially after that PPI print last week. When taking a look at the Cleveland Fed's inflation nowcast, it still has core PCE, accelerating from where it's at right now, which is at 2.8%. They have that going to 2.9 in July, and then to 3.0 in August, which the Fed would definitely not like to see that. And so yeah, they see it's essentially a battle between do we continue to remain tighter because of inflation concerns, or do we start to cut rates? So yeah, it's a lose-lose situation for Jerome Powell, but we'll see what happens. I'm sure he's going to do his best to try and calm things down. So yeah, what we'll do is here, the market has now closed. We can get into some of the questions. Pretty interesting, a little bit of a whipsaw day today. Look at something like NVIDIA at the lowest level today. It was around $169. And then that's had a pretty aggressive buy up pretty much from 11 a.m. this morning till now. So, very interesting rise and fall. For those who are in our macro investing community, we had a ton of things that we were buying this morning. So good looks on that. And so we will continue to buy dips in bullish assets. So if you guys were fearful this morning, it likely means that you are just winging it when it comes to your investing process, which is not a sustainable money-making strategy. And so if you're looking for more confidence in what you're doing so that you know when dips happen, those are dips to buy instead of dips to avoid, again, I would highly recommend that you go to our website and take a look at our resources there, macro-optics.com. All right, let's go ahead and get into some of the different comments here, starting with Instagram. How's it going, Instagram? I think they will cut by 25 basis points to help the consumer sentiment. Possibly, yeah. I mean, who knows? I mean, they consumer sentiment is not part of the Fed's dual mandate, right? The dual mandate that the Fed likes to project, that they like to follow, is stable prices, so inflation, as well as full employment. And when you take a look at the unemployment rate right now, let's just go over to the Fed data. And we'll go to, if it wants to load here. We'll go to the unemployment rate. And so, taking a look at this right here, we see that, it's at 4.1% right now. That's still near historical lows, right? Or 4.2 rather. So it's not accelerating like it was during these recession events. And so check the box there for the Fed's dual mandate, right? So unemployment, even though it has risen from levels that, we saw back in 2022 and 2023 around, 3.0 to 4.0. It's definitely higher now, but it's pretty much just remained, near this 4.2 to 4.0 level, pretty much since, let's see here, pretty much since July of 2024. So it's already been an entire year of the unemployment rate just oscillating between 4% and 4.2%. Some comments from previous FOMC members and Fed presidents have said that the key mark that they're looking at is 4.5% on the unemployment rate. So yeah, I mean, in terms of just the face value, you and I know that the labor market is very weak right now. And when we look at, since the unemployment rate comes from the household survey, when you take a look at the household survey, where people are moving out of in terms of the different buckets, maybe I can actually bring that up here. What is it called? I think it's called BLS Household Survey Chart. I know it's around here somewhere. Oh, I think I saw it. Yep, here we go. All right, so just taking a look at this here. This is how they calculate the unemployment rate, by the way. So they take the amount of unemployed people, which these are people who have either been recently laid off and they're awaiting recall, or they've been laid off and they're still actively looking for available work within the last 4 weeks, right? So those people divided by the entire labor force, which is the employed plus the unemployed, that gives you the unemployment rate. Now, what you notice is that what's not included in the unemployment rate calculation are people who are not in the labor force at all, right? So these are people who, if we scroll down here, you can see that people who are not in the labor force, they can either, not want a job right now for whatever reason, which we'll get into, or they still want a job. But how can someone be not in the labor force but still want a job? Well, these are people who have been searching in the last 12 months for available work at some point in the last year. they've been looking for work, but for whatever reason, they haven't indicated in the last 4 weeks that they have been looking for work, right? And so those are people who are called marginally attached to the labor force, right? So these are people available to work and have searched for a job sometime in the last 12 months, but not in the last 4 weeks. And this is either because they are discouraged, meaning that they believe that no job is available, and so they've pretty much just given up. I don't know how they're alive, maybe being supported by family or something like that. Or they are what's called other, which, that could mean that, they're on disability, or, maybe they've retired, right? Who knows? Or actually not retired, because retired means you're not searching for a job. That goes into the do not want a job, right? So they haven't searched for a job in the last 12 months, or they don't want a job, or they're just not available for work. That's what's called others not in the labor force. So you still, though, have a large portion who still want a job but just haven't been able to look for one. And that's really what we've been seeing is a large portion of the unemployed people have been moving from unemployed to not in the labor force. Meaning, let's just go to the unemployment rate formula. Botch the spelling. All right, here we go. So you have the number of unemployed people divided by the number of, or the total labor force, right? So employed plus unemployed people. Now, if you guys remember from fractions back in grade school, what happens if you decrease the numerator? Well, you get a smaller number, right? If you decrease the denominator, you get a higher number. So if the number of unemployed people were decreasing, while at the same time, proportionally, the number of total labor force is also decreasing, well, your unemployment rate will pretty much remain flat, even though you have people who are being discouraged. They are, no longer looking for a job. They're pretty much giving up, or maybe they're just doing something like, doing Uber Eats, DoorDash, Uber, Lyft, whatever, right? Some of those gig jobs. You're just seeing a massive amount of people just completely exit the labor force, which again, that's not good. A lot of it too has been because of the massive amount of deportations from the current administration. That's not just me being political at all. That's just looking at the numbers, right? And so, yeah, I mean, we're just seeing a large, even though the unemployment rate is remaining steady, the total amount of people getting or moving out of the labor force continues to rapidly accelerate. Let's go ahead and just look at that not in the labor force bucket here, right? So let's just go to not in the labor force. We'll open up that one. Let's go to employed. Excuse me. We'll do employment level, and then we'll do unemployment level. While that loads. See, look at this. Look what's happened pretty much since June of 2024. Do you see this large acceleration here? What we'll do is we'll do change in thousands of people from 1 year ago, just to give you a better idea of this acceleration. Take a look at this. This was pretty much flat from 2021 until, December of 2023. All of a sudden, in late 2024, there's been a massive rise in the number of the people not in the labor force. What about employed? So employed, you've had a little bit of a spike this year, but still remains relatively flat. Let's do the unemployment level. If it wants to load. I don't know what's going on with Fred today. But anyway, you guys can see that the people not in the labor force is increasing, right? So that's obviously a concern. So that's part of also, with the Fed's dual mandate, right? But I'm sure the Fed is seeing that as well, because if someone random on the internet like me is seeing these things, I'm sure the Fed is also. But they want to keep it political, and so yeah, they do have a case to remaining steady as well with their rates. We'll see what happens. If BLS data tends to be off most of the time, how can the Fed navigate effectively with the BLS director Trump assigned? Yeah, I mean, you can say if you want, you just don't believe the data, but I mean, it's still there, and it still is relatively accurate, you know. Um, so yeah, we'll see how it changes, but but yeah, interesting stuff there. We'll see what happens on Friday, which we'll be going live for. How can we trust the Fed cut forecast if it can swing 17% off a little news that seems to be a guess at best, not a true forecast? Yeah, I mean, it can change based off of new data. But, as we get closer to the date, it does tend to be, pretty correct, right? So you can think about it like a hurricane forecast, right? You have like that cone of uncertainty when it comes to a hurricane. But as it gets closer and closer, that cone of uncertainty starts to narrow. That's similar to how it is with the Fed Watch tool, right? So as we get closer, it should start to really pick a side here, and we'll definitely have probably a pretty much clear answer after this Friday. So I work in the pharmaceutical industry and can say anecdotally, I know people who were let go still have not found new roles 6 to 8 months later. PhD trained pharma is on pause with so much uncertainty. Yeah, and instead of filing for unemployment benefits that'll barely get you anything, a lot of people are either starting their own businesses with all the different methods that you can use online in order to generate income, or they're just trying to get by with doing any sort of task that they can. So yeah, it's definitely not a good labor market that's out there. The only thing that I'm highlighting is that because you see on TV all the time how people talk about, oh, the unemployment rate is so low. Well, that's because you're having people completely get removed from the labor force, right? So yeah, it's the way that they calculate things. I think that really what we need to be focusing on is the U6 unemployment rate. So this is the one that I personally like to look at as well, because it does include some of the people who are marginally attached to the labor force, right? So it includes some of those people who are in, this bucket here, not in the labor force, right? So the U6 includes these people here. But Fred is still not wanting to work. We'll let this load as we talk here. I agree. I think the metric has nuance, and right now it may be a lagging indicator. Oh yeah, 1000%, Seth. Like the unemployment rate is probably the most lagging indicator that you can look at. And yet it's what the Fed is looking at, very closely. And so, just like all the time, the Fed is always driving with the rear view mirror. And so, the nickname that Trump gave to Powell, right, too late Powell, every Fed chair has pretty much been too late because they don't want to risk, easing too early, if that makes sense. So, U6 unemployment still not wanting to, let me see. Let's see if I can find it on. Here we go. Yeah, so the U6 unemployment rate, it's still not at levels that are, that we saw during the pandemic. If you do max this out there, right now it's at 7.9%, which, this could start to accelerate here like we saw back in the early 2000s, So definitely pay attention to the U6 unemployment rate over U3, which is the headline unemployment rate. All right. Well, yeah. So just recap here. Heading into the Jackson Hole speech on Friday, we're going to be going live for that. That's at 10 a.m. Eastern time, right? So normally, I go live for the end of the day here, and as of right now, I'm actually not going live on Fridays any longer. But this Friday is a little bit special with the Jackson Hole speech. But you have to remember that the last couple of years have been completely different from this time. You have to look at what the bond market is doing, specifically the yield curve. And so, yeah, with the yield curve kind of doing this crazy thing right now, it has been relatively flat, since the big drop off there in April, right? And so, even though short-term yields have drifted lower, you also had the 10-year yield drop even faster because of growth concerns. But at the same time, you still have the 10-year U.S. government bond yield remaining relatively elevated, right? So the 10-year yield is still, near 4.3% basically, which is in this stagflationary ping pong that you guys have heard me say before, right? And so, essentially, if we can get more data somehow, that because we do have a CPI print, I think 10 days before the September Fed meeting, and so that'll be a huge CPI print. Obviously, probably the most important CPI print of the year, which is that second week in September. So, yeah, a dovish Powell leaning towards more cuts, could push short-term yields down and spark a continued rally in the tech sector. But if we have more of a hawkish Powell, right, with who's emphasizing inflation risks, that could actually lift the front end of the curve, right? It could actually cause the 10-year bond yield to accelerate higher, and then this could be more of a hit towards growth, right? Because if we take a look here and put the S&P 500 on top of the 10-year here, it's pretty much positively correlated, right? So actually, just from looking at this, if something was to cause the 10-year bond yield to sink further, it just depends on the context of it, But I do think a Powell who's concerned with inflation, that would definitely spark the markets for possibly a continued correction here. But we'll see. We'll see what happens. But yeah, anytime Jerome Powell gets on TV, it's because he's trying to sell the market on something. And so always have that in the back of your mind whenever you're watching these press conferences. Jerome Powell is a salesperson. And his words, he knows, carry a lot of weight. That's why he writes most of them down. And so, he's going to choose his words wisely, and he's going to try and convince the markets. If it has to be a little bit more hawkish, he's going to try and convince it more that everything's still going to be okay, though, right? But yeah, so it's looking like it could be some type of make or break event, especially with the market being in stagflation. But yeah, these Jackson Hole speeches, they can be crazy volatile. So we're definitely going to see something interesting happen by the end of the week there. And so again, if you guys want to join us live on Friday at 10 a.m., make sure you guys are tuning in. With that though, I'll go ahead and wrap it up here. If you guys have any questions, you can always shoot me a DM, either myself or someone from my team. We'll respond to your DM. But yeah, we appreciate everyone for joining. Good luck out there, and we will catch you in tomorrow's daily macro update. Bye, everyone.